Welcome to the Australian Property Investment Podcast with your host, Aaron-Christie David. Each episode, we ask an expert to share their key insights for aspiring investors to make confident property choices.
G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. My name is Aaron-Christie David. I'm the mortgage broker and founder of Atelier Wealth. This podcast was designed to help property investors answer a lot of their frequently asked questions, but also help you make better quality property decisions. When we kind of hit up a lot of our guests, we often turn to what I call best in breed. So industry leaders, people that have solid reputations, solid businesses, and they come from a place of love, which is serving and giving back to their clients as well. Our guest today, I'd almost call him buyer's agent's royalty. I know he'll probably blush when I say that because he's quite modest. But our guest today, Simon Presley, is the head of property market research at Propertyology. He probably needs no introduction because his reputation precedes him. But for those that don't know, Propertyology produce some incredible content. They've been around for a very long time. And Simon actually is a Hall of Famer as well. So Simon, welcome to the show.
Thank you, Aaron, for those kind words and for inviting me on your great podcast.
No, thank you very much, man. I just want to kind of start with you as a person. I know we had a chat about you and your family and where you are, but just want to kind of give us the 1 minute rundown into who is Simon Presley as well.
Who is Simon Presley? I'm your everyday Aussie that is incredibly driven to help people and provide for my family. And investing is something that even before I entered the workforce, as in my late teens, was something that was important to me. I think I learnt inadvertently from my parents and aunties and uncles seeing the consequences of them not prioritising investing, how important that is. So chose a banking career, loved numbers, bought my first house at the age of 21.
Yeah.
And ever since been a very active property investor. Wonderful.
So, I mean, let's go there because you've talked about property at a very early age and you talked about family, right? I often say that family will shape a lot of your money habits, you know, how you see debt, how you use money, how you spend money, for example. Families that may have had bad experiences with investing in property, then pass that on maybe to their children as well. So can we just go there and say, look, what was your experience as a family and property that kind of led you down this path as well, good, bad, or ugly?
Yeah, great comment. I think we do learn a lot as children, but we don't probably recognise until we're later in life what we did learn. And sometimes we learn things by actually being sat down and things explained to us in a traditional classroom format. But our parents can do that with us at home. But other times we learn, I guess, just by observing things. And so my experience as a child in property, mum and dad never owned property. So I was raised as a military child. My father was joined the army. I think he was about 19 years of age. So, my entire school years, it felt like every two years I was living in a different part of Australia. And my parents' accommodation was provided by the Australian government, the Defence Force. Yeah. So, buying a home was never important, mum and dad, because they were not in the one place very often. Yeah. But what that did for me was it gave me, looking back on my childhood years, it exposed me to an enormous part of Australia, capital cities and regional locations. Now, as a child, you don't take that stuff in, but as an adult, especially in my chosen profession as a national property market analyst, it keeps me very much open-minded to every part of Australia.
Yeah, right. And what then made you make the jump to and give you that confidence to go from coming up from being raised in a household that didn't own property to then going and buying investment properties? That's a significant jump, I guess, in self-confidence and self-belief, right? So how did you then make that confident step to then buying property for yourself, Simon?
Yeah, I never verbalised it to anybody, but I had an incredibly strong determination. Probably my recollection was maybe at about the age of about 15 or 16, believe it or not. Yeah, right. That I was going to own a family home. And where that incredibly strong drive come from was realising that mum and dad, not only had they not achieved that themselves, I realised that they were probably never going to achieve that. Wow. And when I realised how sad that was, not that it was their fault, and mum and dad are incredibly hard-working people with great values that they passed on to me, but they were never taught financial literacy. Yeah. And because they never prioritised not only home ownership, but investing for their later years, their retirement years, I became aware of that in my adolescent years and thought, that's not right. That's not their fault. Yeah. But make sure that I don't repeat the same thing. And of, one, making sure that I didn't do that, but I helped others, to make some better financial decisions during their time in the workforce.
Spot on. I think one thing you've just nailed there is a lot of, maybe baby boomers, even people today, they work incredibly hard for their money, but their money probably isn't working as hard as it could for them. And so that's why investing in property, we say to a lot of people, can be a very great way to secure your retirement or long-term wealth, family wealth, whatever you decide that it's going to take you down. It should be part of that, I guess, that wealth planning part. But a lot of people just don't know how to get it right, or they've had bad experiences or bad stories, isn't it?
That's right, Aaron. And unfortunately, society has never taught financial literacy, even to this day. And I'm a father. I've got a teenage son. We don't teach even basic things like budgeting, let alone investing, let alone explaining how miserable life would be on an age pension. I think if people realise that stuff, suddenly they would prioritise better spending habits, and would make, I guess, investing a bit like a household bill. It would be something that they would just allocate every pay packet that they've got. They'd be setting that aside for the future. We can all do it, but very few of us do it because I guess we don't have enough understanding of it. Yeah,
correct, mate. Love your ethos. Another one of, I guess, your big ethoses is, and it was a comment that I heard you say, which really stuck out to me, that capital cities equals capital growth, and that's where a lot of investors typically go to. But you have a very different philosophy when it comes to finding and looking at locations for investment properties. Can you just take us through? I guess we'll go down that rabbit hole and say, look, take us through, I guess, your philosophy and your beliefs around where investing in property, and maybe it's not as important as what people think it is.
Yeah, look, property will always be a very emotive topic. Let's face it, we all live in a property, whether we own it or rent it, we live in a property. And it creates, for a lot of people, it creates a false sense of confidence, including plenty of people who might already be active property investors themselves. It's actually really, really complicated, property markets. I've argued since the coronavirus that other than developing a vaccine for the coronavirus, property markets are possibly the most complex thing on this planet. And it's full of misconceptions. And one of the biggest misconceptions is that capital cities are better. That the word capital within capital city has something to do with capital growth, not supported at all by evidence. Others think that capital city means safer because there's more people living in it. Again, not supported at all by evidence. Don't know where I get this from, Aaron, but I'm a very evidence-based decision maker. Before I make any big decision in my life, I need to see the evidence. And I've learned that a lot of things that, even though there could be millions of people in society believe about property, often are not at all supported by evidence. I'll give you a very simple fact I love quoting. Over the last 20 years, the average annual capital growth rate of a house in Wangaratta, now most people don't even know where Wangaratta is on the map, it has had a higher average annual capital growth rate than the apartment in Sydney, our biggest city.
Yeah, right.
That is a fact. That is not 1 year, that's over the last 20 years. So capital city is just a term. Region's just a term. If we looked at a different asset class, if we thought about the stock market, it's like comparing financial stocks to retail stocks or tech stocks. They're just terms. It doesn't define which stock on the stock exchange is better or has the better potential. And exactly the same can be said about property markets. I've got some, if we've got time, I've got some facts for you the last 5 years. Have we got a couple of moments to go through that?
Absolutely. Let's go there.
The best performed property markets in all of Australia over the last 5 calendar years. I won't go through all of them, but we'll start down the bottom. Adelaide, Brisbane and Sydney, the median house price grew by roughly 15% over the last 5 years combined. On the next tier above that, grown by between 20 and 35%, we've got places like Coffs Harbour, Lithgow, Sunshine Coast, Wangaratta I mentioned earlier, Kempsey, Swan Hill, Maitland. The next rung above that, 35% to 50% growth over the last 5 years. The best performed capital city was Hobart. But you've also got places like Colac, Shoalhaven, Geelong, Launceston in beautiful Tasmania, Orange. So that's 3 times the rate of growth of Sydney, Brisbane and Adelaide. And the best performed property markets, in excess of 50% over the last 5 years, we've all heard of Byron Bay, but also Macedon Ranges, Warragul, Wonthaggi, Mornington Peninsula, and Torquay. Most people wouldn't know where those locations are.
I'd put my hand up and say I wouldn't know half some of those suburbs where they are, but your job as a buyer's agent is to go, this is what the data is saying, and maybe changing people's perceptions about capital cities being a safe bet versus regionals. And like, where does that riskiness that gets attached to regional towns come from? I know that maybe mining towns may have had that, where people may have gone into mining towns, consider that regional and gone, well, it's where hearts get broken perhaps. But what are some of the other reasons that maybe hold people back from looking at regional markets versus the safer bet, what we'd consider safer options being in a capital city, for example?
Possibly the most common question I ever get asked, Aaron. So it's a fantastic question. Look, there is a big difference. I describe it as the difference between a real risk and a perceived risk. A lot of the things that we associate with risk in property are perceived risk, which aren't supported by evidence. And part of my role, I guess, is to understand why people think a certain thing and then respond to that with evidence. And so perceptions can be changed with evidence, with knowledge. But I think the stereotypical stories of the one industry mining town that we've all heard, the media love the blood on the street story. And very rarely do they write a story about a regional location unless it is a blood on the street mining town story. So if you've spent most or all of your life living in a capital city and you've got interest in property markets, that's mostly what you're going to read. So your perception over the journey through your life has been that regions are risky. But they're actually talking about a very small percentage of Australia's locations. So we've got obviously 8 capital cities, but in total we've got about 200 individual regional towns and cities. There's some really big regions amongst those, places like Newcastle, Wollongong, Geelong, Sunshine Coast, Gold Coast, Townsville, really, really big regional cities. There's a number of what I call medium-sized but mini capital cities. So what I mean by a mini capital city, that's a propertyology term. Yeah. It's got all the essential infrastructure and a diverse economy that a Sydney, Melbourne, Brisbane would have. It's just got it on a smaller scale. So they're places like Orange and Bendigo and Ballarat and Mackay and Cairns, Bunbury, Busselton. They're all over Australia. But what constitutes risk or has the biggest risk in a property market is when the local economy of the individual town or city lacks diversity.
Okay.
Now, we've got some capital cities that, in our opinion, lack sufficient diversity. Perth, for example, our 4th biggest city, a capital city. It would not have mattered what property you or I could have bought in Perth 10 years ago.
Correct.
It's worth less today.
Spot on.
All right. Darwin, the same. Canberra, our nation's capital, 33% of jobs in Canberra are employed by the government. It lacks diversity. But those locations I mentioned earlier, and there's about 40 or 50 of them in total throughout regional Australia, have incredible economic diversity. They've got, in most cases, more affordable housing than our capital city. So that's another correct measurement of risk.
Yeah.
And what they don't have in a lot of cases is a construction sector or a big segment of their workforce employed by the construction sector. Construction sector is what controls supply. Okay. So a few years back, Sydney and Melbourne had a significant property market downturn that was caused by an overstimulated construction sector. So there's a few components there that as a property investor, we need to understand the difference between real risk and perceived risk.
Yeah, absolutely. And I think, when you reference people that live in, say, capital cities that are conditioned to go, this is where you need to be, it's almost because we're told that you need to invest in blue chip locations. And quite often regional would never register to a lot of investors, myself, going, these, you would consider them blue chip, but being in a city, we wouldn't consider Wangaratta blue chip.
Yeah. And I think there's a big difference between blue chip in regards to where the multimillionaire might want to buy their family home and live in and blue chip property investment stock. I would argue that the locations that broader society describes as a blue chip property market would be the last places that a property investor would want to put their money in.
Yeah, right.
It makes I'm going to name a phrase here we've all heard of. Never place all your eggs in the one basket.
So in that case,
basic common sense, isn't it? Right?
Oh,
a share investor is not going to put $200,000 of their hard-earned money on Commonwealth Bank. because something could happen to Commonwealth Bank and all of the value of their investments goes down the gurgler for a sustained period of time. A business is not going to have a high percentage of their annual revenue coming from that one customer. We've all heard of that statement, don't put your eggs in one basket. But property investors, if they can afford the $1.5 million house in a so-called blue chip suburb in Sydney or Melbourne, that's what they do.
So let's go there. You go 1.25, you could buy a property in, say, Surrey Hills. Close to the city, ticks a lot of boxes, right? Very, very investor friendly, for example. What would be the argument then to go, hang on, don't buy the 1.2, maybe buy 2 at 500K, for example? Like, how do you then counter that argument when people go, should I buy 1 at $1 million or 2 at 500, for example?
Yeah. So if we look at a Surrey Hills or something like that, over the last 20 years, if we did that today, I'd be very confident that in 20 years' time, we would not be disappointed with that decision. But in saying that, I'd also be very, very confident that we could have used the same amount of money and broke it up into smaller parcels, the same way that a share investor does it, and bought 2 or 3 properties and not just multiple properties, but in multiple locations.
Right.
In the same way, the share investor has some stocks in the financial sector, the tech sector, the mining sector, or whatever. Propertyology would break the investment capital up in the same way. So we're taking advantage of more opportunities. We're minimising our risk because we have not got all of our eggs in that one basket. The historical evidence shows us that the Surrey Hills of the world, whilst they perform well, they're very much middle of the road. Plenty of other parts of Australia. I mentioned at the start of this interview, Wangaratta, the location that no one's heard of, how it's done. And that's not an isolated location. So we would be looking for the equivalent of those 2 or 3 Wangarattas, a standard house that today we might pay $500,000 for, and roughly buying 3 of those in completely different parts of Australia, each location having a different economic profile.
Right.
So different industry sectors that are most important to local job creation. And it's also much safer for the cash flow. The cash flow on that one expensive property worth $1.5 million will be a heck of a lot worse than 3 properties that are collectively worth $1.5 million.
That's a question that comes up a hell of a lot of time when we're talking to clients is like, should I go all in and buy the one bigger property, bank it all in one, versus could I split up over 2? And now I've got potentially 2 properties to manage, where it's like, well, hang on, the risk versus reward could be better on the 2 properties is what you're alluding to as well.
Yep.
Yeah, great. I mean, you mentioned the Propertyology way, and one of the things that really caught me was you were the first buyer's agent to pick Hobart. And I know that from our own experience, Bernadette, my wife, and I, we got presented with Hobart quite a few years ago, and we looked at each other going, Hobart has done nothing for like 10 years, and this seems like a risky bet. And you were the first buyer's agent to go, Hobart is the place for investors. So I really want to kind of go on, what was the attraction to Hobart? What was it about this particular, because it has been one of the, I guess, the success stories of, property investing, that it's, gone on to do incredible numbers. And I can put my hand up and say, we definitely missed that boat. But how did you then go, there's something about this location?
Yeah. Look, it's a long time ago now, Aaron. It was 2014 that Propertyology started investing there, and we stopped investing there in early 2016. So a long time ago, but it's a great success story, not just for our clients. We've deliberately used, because I guess all of Australia knows now how well Hobart has performed.
Well, hindsight's a beautiful thing, isn't it?
Yes, yeah. We've tried to use it because people are aware that over the 7 years since we invested there, it's literally been the best performed property market in Australia. Yeah. Knowing that people are now aware of that, we've tried to use what actually caused Hobart's growth to educate people, and try to break down some of those barriers and misconceptions. How do we pick it? It starts by first looking at those 200 locations we were talking about earlier, all of them. Investors don't do that.
Yeah.
99.9% of investors never think of anywhere other than their hometown, so they give themselves no chance of doing any well. Or if they try to be a little bit creative, let's say they live in one of our capital cities, they might consider that, investing in one of 2 or 3 other capital cities. That's as far as they consider. So step number 1 for us picking Hobart, not just in 2014, but every single day, considering objectively the fundamentals of every location in Australia, removing all bias. I've trained myself to totally ignore what economists and many so-called property market experts say about property markets. Because if I followed what they said, we never would have discovered Hobart and many regional location successes.
Yeah.
We've placed a lot of evidence, a lot of credence on respecting growth cycles, knowing how to read cycles, knowing how to read the three segments of housing supply. That's where pressure comes from, and it's also one of the key risk components. So when we identified Hobart in 2014, whilst the market had been flat for several years, it actually had tight housing supply in the three components: new construction, resale supply, and rental supply. And where the demand comes from, contrary to what most people think, population growth has very, very little to do with property price growth. Cannot stress that enough. The second biggest myth in property markets is that people get fixated on population growth.
Absolutely, yeah.
If I digress for a second, here and now today, Australia's national population growth has been its lowest rate for more than 100 years, way back in World War I, but yet we've got the second biggest property boom at the moment in our nation's history.
Yeah, right.
So Hobart, the demand side of things, whether that's Hobart or any other market that we've picked, is understanding a big bunch of decisions that have been made in recent years that are going to have an influence on a local economy. And when we've got a big enough critical mass of decisions that we're aware of that give us confidence of job creation, that's the leading indicator for future property price growth. Because what it does, job creation puts upward pressure on wages, and most importantly, it creates confidence in a local economy. And confidence is what's needed for someone to go to an open home or an auction. Without confidence, they don't want to go into debt. They're certainly not going to buy a property.
That's spot on. I can see just over your shoulder there the trademark orange with the Propertyology research, which you guys have become famous for. And you guys produce some incredible array of data, content, for example, comes out on a very regular basis. What has been, people love it and they resonate with it, for example, but the driving force behind Propertyology's success is that you are so in the data and that you're so in the research, for example. So talk us through your methodology when it comes to producing all of that content, and then I guess how you get that out there as well, please, Simon.
Yeah, look, I personally write these, roughly once a fortnight. We produce a blog, which we distribute via a free subscription basis, just through electronic newsletters. And our objective for that, there's no sales material in that. It's not, how good are we, or we don't sell property. We've got no vested interest in anything. We're prepared to give away big pieces of our research and our insights to try to educate the broader Australian public. So whether it's dispelling the population growth myth that we were talking about earlier, or talking generically about capital cities versus regions, or sometimes we'll produce a case study. We'll pick an individual location and we'll pull it apart and explain it through the eyes of a property investor, as opposed to through the eyes of a resident who might live there, removing the bricks and mortar and treating property as a financial instrument. So that's our objective with producing those blogs roughly once a fortnight, is to educate. And in doing that, what we're doing is demonstrating our skill. And I guess someone who's been reading our content for a period of time, it gives them an opportunity to work out for themselves how they evaluate our level of skill and knowledge. And if they're looking to invest at some time in the future, I guess they've had a bit of a taste of what we're about. So that's what we're trying to do with that.
I think you just touched on it before. You pretty much give it away. So there's not really that trade secret where you have to sign up and then the engagement fee, like to get hold of your data. It's like, hey, we're such an open book with all our data and our research. We just want to give it away because you also want to pay it forward to people that want that information to go, here it is. There's no secret source to it. But we actually want to try and, I guess, raise the bar for investors and go, make good quality, educated decisions. And if they are looking to engage with you guys, they know what you're about and they know what you stand for as well, isn't it?
Yeah, we are very, very generous with what we give away. All of the trade secrets will never be given out there. We're never going to say, here's an ex-Hobart guys, jump in here. Yeah. Those who pay Propertyology, engage Propertyology and pay us a fee for service, they definitely get that. But the broader public, the free
it's like chefs, mate. They don't give away all their secret
really
recipes,
good quality information.
Yeah.
But no, we're never going to be giving away the absolute trade secrets of, where are we investing now?
Yeah.
Now, right here and now today, we're investing in 10 completely different towns and cities across 4 different states, but I'm never going to share that with the broader public.
On a personal note, Simon, I guess you live and breathe this yourself. What has been some of, I guess, the upsides, and what's been some of the, I guess, the lessons you've learned when you've gone through your own journey, when you've been buying and building a property portfolio?
Yeah, look, no one's perfect. And as I mentioned earlier, Aaron, I'd argue there's nothing more complicated on this planet than understanding property markets, and especially we've got so many of them. And, some of the best learnings I've got has not been by intentionally, going through my daily motions of researching property markets every day. It's actually been through personal experiences. So we've got, I guess, formal studies we've done. We've got our daily research activities that we do, but we've also got our personal experiences.
Yeah.
We're now up to 19 individual towns and cities across 5 different states that we've invested in at different times.
Wow.
We've spoken about Hobart, that's still doing exceptionally well now, but there's also a long time ago now, but we also had a couple of locations that did not perform well a couple of years after we stopped buying there.
Yeah.
And I probably learned more from those experiences than any other studies. There's nothing more powerful than going through personal pain. I personally invest in the same locations that our clients invest in. When you have financial pain, it's a bit like if you ever banged your thumb with a hammer. It bloody hurts, doesn't it? But if you don't learn what caused that pain, you only got yourself to blame. So if you've invested in property and then years later it's not performing the way you want, my advice to anybody who's experienced that is to reflect on your original decision. And that's what we did. So when Sydney and Melbourne had its oversupply downturn a few years back, we saw that boom. We saw that downturn coming and publicised their forecast for that even during Sydney, Melbourne's boom. But how do we know that was coming? Because years before that, we had been through a completely different market that went through a downturn caused by oversupply.
Yeah, right.
There's no way of us knowing that at the time of investing there that was on the horizon. But when we actually went through it, we took the time to understand what caused this performance that we don't like, and is there a way that going forward we could anticipate that occurring again.
Yeah, nice.
Another location had a downturn caused by a weak local economy. At the time of investing there, the local economy was fine, but years later it became weak. So it's those personal experiences and that personal pain, there's no greater teacher if you reflect to learn from that. And that's an effective way for distilling some of those myths.
Absolutely, mate. Thank you so much. Look, you've been super generous with your time, been super generous with your insights as well. As we wrap up, I just want to just ask you when you're dealing with investors and I ask this of everyone that we bring on the show, that maybe get stuck or they're stuck in that analysis paralysis zone, or they don't know what step to take next. What's your parting bit of advice for them that would help maybe give that confidence or that reassurance to say, this could be a rewarding journey for you?
Maybe when I get around to writing a book on that great question. So a few general tips. Your hometown is where you prefer to live. And that's a very personal and subjective, albeit very important decision. But if you're about to invest, I would encourage everybody completely disregard your hometown, especially if you own your principal place of residence there. If you're about to invest in your hometown, you're putting all your eggs in the one basket. So you don't owe it to me or anybody else. You owe it to yourself to consider 100% of your investment options. That's 8 capital cities and 200 regional locations. If you don't consider all of those, you're not giving yourself a very good chance of realising your full potential. Second general tip I'd give is to be aware of the confirmation bias.
Spot on.
We've all got one. For those who aren't familiar with that term, what that is having an emotional attachment to something that you want to see happening. The common example is the family home. We want to invest. We'd love our family home to be the next boomtown. So we kid ourselves with thinking we're researching, but all we're doing is reading what's probably a whole bunch of crap on the internet and looking for information that's talking positively about our own market.
Yeah.
So we can justify why we really, why we're making a decision that we're really going to make anyway, because that's what the heart wants us to do. So be mindful of that. Pay a lot less attention to the aesthetics of a property than the actual town or city itself. The most important decision to get right is the town or city that you choose to invest in. that will do about 80% of your investment lifting as opposed to the specific property asset that you buy. 3 general tips.
No, mate, I love it. And I can hear people, I can feel clients squirm when I say, don't look in your hometown, because it's like, it's the safety net. It's like, hang on, but it has been performing, and it's hard to argue because it has been performing, but then also it could actually be higher performing if you looked maybe outside your hometown as well, isn't it?
And especially now, because
Correct.
Today we are at the first time since 2003 in this country, Aaron, that literally every location in Australia, all of those 200 locations in Australia, property prices are growing.
Correct.
That has not happened since 2003. So no matter where you live in Australia, if you're contemplating investing today, you've got this extra bit of false sense of security right before your very eyes that's saying, my hometown is performing well. Of course, this is a great decision to buy here. You need to understand the fundamentals, because there could be something around the corner in your hometown that you're not aware of unless your profession is studying property markets nationally all day, every day. You probably won't be aware of what might be around the corner in the next couple of years.
Yeah, spot on. Mate, you went on the record kind of when Corona hit that, property prices would grow in value. And so that's come to fruition. Your feel on when the market's headed at the moment, what are your thoughts?
Yes, we're on the record saying that, and copped an awful lot of criticism.
Absolutely.
For it, I must say as well, Aaron, because I think I was probably only one out of 26.
Well, every other bank economist was saying otherwise, and you're saying the exact opposite.
Yeah. Where's it heading? It really depends which part of Australia we're talking about. I think there'll be some locations that maybe as early as the end of this calendar year will see their market more normalise. I'm not a betting man, but if I was to have a bit of a guess as to which markets they might be, I think Melbourne will be the first that will slow down, and we actually have some concerns for Melbourne's market. Not a crash, but every possibility of some price declines in Melbourne over the next couple of years.
Right.
I think Sydney might normalise at some stage over the next 12 months.
Yeah.
But I think that we're going to see many other parts of Australia that could continue to see the rates of growth that we've seen over the last 12 months for several years. There are parts of Australia right now that are growing at least 20% per annum pace. Phenomenal stuff. Now, what will why each market is performing differently, different volumes of housing supply, local economic conditions are different. There's confidence everywhere at the moment because there's so much stimulus in Australian property markets, but the stimulus stuff is what I call a sugar fix. Sugar's not a reliable or a sustainable energy source. So we need to be mindful of that and focus on the sustainable energy stuff, which is the local economic factors. But there could be some markets in Australia that, believe it or not, Aaron, might grow by as much as 100% in 5 or 6 years.
They're incredible numbers when you think about it, isn't it? And it goes to your point that now we're going to start to see that there are markets within markets, whereas the last 12 months last 6-12 months in Australian property market has been a rising tide has lifted all ships across all markets. We're going to start to change and fluctuate within specific markets as well, isn't it? Yeah, great.
We've got record low interest rates, and I think that will remain very low for many years. But again, not a betting man, but I wouldn't be surprised if we see the RBA make its first interest rate increase during the 2021-22 financial year. At some stage over the next 12 months, I wouldn't be surprised if we see our first rate increase. Now, if that happens, that's not a bad thing. If the RBA do that, that will be because they have zero concern of the economic recovery from the pandemic. That'll be well and truly behind us. And because for the first time since before the GFC, we're seeing wage growth. I reckon Australia is in for some considerable wage growth. So if those two things happen, the RBA historically, that's when they increase interest rates.
Yeah, the wage growth I call COVID clarity. For a lot of businesses, they've come out of this going, hey, look, we're actually coming out of this better, bigger, stronger, for example. I mean, you mentioned that your team's working from home and things are great. A lot of businesses, property specific, for example, they're coming out of this going, hey, mate, we're actually doing far better than what we thought we would have. And that clarity is there in their businesses and the confidence is there to go with it as well.
Yes, in over 200 years of Australian history, there's been all sorts of moments of significant adversity, world wars and global financial crisis and health pandemics. Out of every single adversity is a significant economic rebound. I guess adversity is a bit like a slap in the face to human beings. It gives us a big shake up and we dust ourselves off, and then we've got that competitive spirit And sometimes it's a slap in the face that we need to wake up that competitive spirit. And that's where we're in now.
Hey, Simon, thank you. You've been so generous with your time, with your insights as well. I want to say thank you very much on behalf of our listeners, on behalf of our clients for sharing your tips and your insights with us, mate. I really appreciate it. Thank you very much, Simon.
My pleasure.
Beautiful. That wraps up another episode of the Australian Property Investment Podcast. If you found it helpful, please leave us a review. Please hit us up with your comments as well. Simon's details will be in the comments below. So if you want to check out Simon and his team at Propertyology, find out what they're about, subscribe to the newsletter, feel free to as well. The details will be in the comments below. Simon, thank you very much. And until next time, it's Aaron-Christie David signing off. Thanks.